Well, hello everybody. Welcome to P.B.M. Money. Well, tonight I want to talk about the coming crash. Now, I know there's a lot of people out there talking, and right now it seems like everything's going really well. I mean, everybody looks like a genius that's in the stock market. I've only got about 5,000 invested, and I've already pulled out 3,000 in profits. I mean, holy cow, and I've only been in it 5 months. So we all look like geniuses right now, right? Well, one of the things that concerns me is, for those of you that know history, do you remember the Roaring '20s? That was the decade before the stock market crash and the depression. Remember that? Now, the government has put in, the stock market has put in a lot of safeguards to protect us from that getting out of hand, but it's all, everything is coming together for the perfect storm. But right now the stocks are up, gold is up, which is odd. Why odd, you say? Well, because when the stock market is up, there are two things that should be down: bonds and gold. Gold's not down, and bonds aren't down like they should be. So that tells me that there is a lot of trepidation on the part of the investors, with good reason. So tonight what I want to do is I want to talk about not this part of it. I just want to say right now everything looks great. I mean, the economy looks good, the stock market looks fantastic, everything is going great. And yet, the fundamentals, as I see them, are not that great. What do I mean? Well, when you read, watch, or listen to talking heads that are supposed to know what's going on, they all say the fundamentals are solid. What they're talking about, though, is the business fundamentals. And I would agree, from what I know, I would agree with them. That's not what I'm looking at. I'm looking at the government and the national and worldwide economic fundamentals. And those look terrible to me. What do I mean? Well, one of the reasons that our economy is still doing well, in spite of the stupid economic policies of Biden, is because they are continuing to print money, and oil prices are going up. Our dollar is based on petrodollars, so that the price of oil backs, if you will, the US dollar. So when oil goes up, the dollar goes up, and our economy looks like it's going up. That's what's happening. In reality, the government is printing way too much cash. I mean, in the last year, we are getting ready to sign the third stimulus program. This one is almost 2 trillion, or trillion. Isn't it sad when I can't remember if it's trillion or 2 trillion? It's that much cash. And this is the third one. So those of us that, even if you only went to high school, what happens when you have too much cash in an economy chasing too few goods. Inflation. Now, the Fed has managed to do that by instituting some rules. One of them is they're buying treasuries, okay? Which is a temporary thing, but still what that means is the federal government is buying the federal government. They're artificially keeping the value of the dollar up. Now you have to ask yourself, if the stock market is up and gold is up and the bond market is not down where it should be, what is that telling you? Well, that's telling me that something is keeping the stock market up, and the real fundamentals are gold and the bonds. They're manipulating the dollar, and they're using the gold and the bond market to help do that. Not to mention printing all the cash. But I don't want to get into the weeds of economics on this, even though I'm not an economist, just an investor that's been around the block. What I want to talk about is, we know from experience, just as investors, that some investors would call it a correction. I'm going to call it a crash because I really believe it is going to crash, and crash hard. And here's why I believe that. The fundamentals from an national economic standpoint and a worldwide economic standpoint are absolutely terrible, in my opinion. We're artificially keeping that up by doing a lot of things. But at some point, that's going to catch up to us. Inflation will happen. So as investors, we have to try to take steps right now to protect ourselves so we're not throwing ourselves out of buildings like they did in the 30s. Okay, so we don't lose everything. Because right now, everybody's doing great. Everybody's all in on the stock market. Let's all dump our cash there. I'm not doing that. Now, there are some recommendations that I would like to make. One of them is that I would, right now, growth stocks is the place to be. I would slowly, and by slowly I mean in the next 12 months, I would move the majority of my money from growth stocks to blue chips. Why blue chips? Because even if the economy crashes like it did in the 30s, there are still going to be some things that have to be here, and those will be the blue chip companies. Those will be the companies that will survive anything. That's where you need to put your money. If you want to stay in the market, stop investing on your own. What I'm doing is I'm pulling my profits as often as possible, and I'm putting them into a mutual fund or any type of fund. And I'll tell you why. I'm just a guy, okay? But these people at these funds, they make their living professionally managing money. Now, they may lose a bunch of it for you, but I don't believe that they will lose it all. If the market goes down 30 or 40%, they might lose 30 or 40%. But if you try to manage your money, you will lose 80 or 90%. So you have to protect yourself against the odds. That doesn't mean you try not to lose, you just try to minimize your losses. Now, does that mean we pull ourselves into a shell? Absolutely not. I think that as we look for investments, as we look for stocks, as we look for places to put our money, I would still experiment. I mean, it's what I call it. I find what I think is a growth stock, what I think would be do well in the next 6 to 12 months, and then I'd put some money there, just in case. Now, over the next 12 to 18 months, I would slowly increase my cash position. Now, cash may mean in the bank, it may mean in the lockbox, it may mean in collectibles or gold or silver. I'm looking at collectibles right now because I'm not convinced that the spigot hasn't been shut off on gold and silver. I think that price is being manipulated also. But collectibles, that's a little harder to do. While I'm still in the growth market, I'm going in and cashing in my profits as soon as possible. And I'm going to take that cash and I'm going to put it to better use and so that it's not exposed. In the old days, I would have just left it there and let it ride until I thought a crash was coming. However, I feel like the crash is overdue. They are postponing it, just like they did with the economic crash back in 07 and 08. I think that's what it was, when the banks failed. They tried to keep that artificially alive by pumping billions and billions of dollars into the economy. And all it did was stretch it out over a long period of time. So take your profits, make better investments, and when I said put it into blue chips, so you're saying, okay, well, blue chips is just going to protect my money. I still want to make some money. And I agree. So what I would do is I would switch, and I have, by the way, I have switched from actively seeking growth funds or growth stocks, and I'm now looking for and investing in dividend stocks. And there are a lot of them out there. And if you look hard, you can find some that are solid, that are still giving good dividend with at least stability. Most of your blue chips, they will pay you dividends, but they're going to be minuscule. I looked at Boeing tonight. Boeing stock dividend is 0.89%, not even 1%. Now I know it's a tough economy and I get it. I own, I don't know, I don't know how many shares, but I got from Exxon, I got $4 whole for this quarter. So Exxon's going to pay me $12 for $12 for the whole year for owning their stock. I mean, you're not gonna make money on blue chips. But if you go out and you can find dividend stocks that will pay you anywhere from 3, 4, 5, and if you find the right type of stock tied to real estate, by the way, you can get 6, 7, 8 and higher percentage depending on your level of risk. So let me restate quickly the steps that you should take to avoid or minimize your losses. You can't avoid it. It will happen. It's not a question of if, it's a question of when. And that's why I say slowly on these things. I would slowly move to blue chip stocks. That would be to protect your assets. Would also put them into mutual funds. That way you can still benefit from the overall part of the stock market, but limit your losses to individual stocks. I would still look for some experiments or some risks to take. a small percentage, but I would still do some. I would also slowly, by slowly I meant 12 to 18 months, increase my cash position so that when the market does crash and you think it's at the bottom, which by the way, they say that the history shows that the crash goes down and lasts for about 89 days. So at the end of 3 months, that's when you should start buying. So slowly increase your cash. When it looks like it's going to happen, wait 3 months and then go back in and start buying. That's what history says is the smart thing to do. For right here and for right now, take your profits often. Protect your profits, because if it turns into a bear market quickly, you're going to lose your profits quickly. So pull them out and keep them more safe. And lastly, concentrate on dividend stocks, not growth stocks. I went looking for some growth stocks a couple of weeks ago, and oh my goodness, they used to be plentiful. Now they're hard to find. There's a reason for that. Slowly transition from growth stocks to dividend stocks, not growth stocks, and do it quickly. Well, that's about all I wanted to say. I think this is a very important video. History or time will prove if I'm correct or not. History says I am, and I'm just I'm trying to prepare you slowly. It is going to happen. The question is, will you be prepared? I'm going to try to be. Well, you guys have a great week, and happy investing.